So how will the future of Europe affect U.S. monetary policy when the Federal Reserve begins its two-day policy meeting tomorrow? Let's find out from a guy who's been there, Robert McTeer, former president of the Dallas Federal Reserve. Bob, welcome back to Nightly Business. How's the weather in Dallas? Is it good?
70 degrees and sunny.
Oh. All right. Well, you know, in New York, it's all about New Yorkers. I'd love to be there. Why, in a phrase or two, does Europe, Greece, and the euro matter to individual U.S. investors? Why should we care?
Well, in a way, we shouldn't. Greece is a very small part of the eurozone, and we're not as dependent on international trade as a lot of countries. On the other hand, to the extent that their problems affect the price of the euro in terms of dollars, it would continue to cause an unhelpful increase in the strength of the dollar. Strong dollar is very good for a country that's not fighting recession and low and high unemployment, but everybody has devalued against the dollar, and it's time for it to come to an end, I think.
So, Bob, does the situation in Greece, the strength of the U.S. dollar, affect our monetary policy here at home? With the Fed meeting this week, do you expect any changes due to the situation in Europe, in Greece?
Well, to begin with, they weren't going to contemplate changing policy until the middle of the year anyway, so it won't affect anything now. If similar things are going on, though, in the middle of the year, I suspect it will delay the Fed's beginning of normalization of interest rates. Already, what's been going on over there has pushed our rates down instead of up, and our rates are still considerably higher than European rates, which are negative in many cases on the short end of the yield curve. So we're getting headwinds from a weaker euro and unwanted tailwinds, probably from interest rate arbitrage.
The stronger dollar means that American companies might not export as much as they otherwise would to Europe, and a weaker euro means that European imported goods cost less. So that's exactly what the Fed doesn't want: low inflation and an economic situation where there is that headwind right on the bow.
You're exactly right. In normal times, those things would be good things: lower inflation, cheaper import prices. But in normal times, lower oil prices is good too. But we got a little too much of that too fast, and this feels similar, and they're happening at the same time. It's a little bit scary.
All right, Bob. Thank you so much for helping us through it tonight. We appreciate it. Robert McTeer.
Thank you.
Robert McTeer, former president of the Dallas Federal Reserve.